You know what I'm saying? Michael Jackson up in this building. All right, what's going on, y'all? Welcome to Average Money Works. Thank you for tuning in. Today we're going to do a quick update on my account. I got into a credit spread. So what a credit spread is you basically you agree to buy shares at one price and you also agree to sell shares at another price. So I did it with AMD, and basically what I did was I agreed to buy 100 shares of AMD at $82 if it's below $82 by this Friday, December 4th. So I'd have to spend $8,200, and the reason why it's 8,200 not 82 is because contracts are always deal with 100 shares at a time. So you have to multiply everything by 100. So 8,200 is what I would have to spend on 100 shares of AMD if AMD falls below 82 by the expiration date. But because I did it in a credit spread fashion, the minute I have to buy 100 shares, I'm going to sell it to somebody else for 81.50, which is at 81.5. 81.5 times 100 is 8,150. So my max loss would be $50. And because I did it as a credit, because I'm going to be losing money here, I actually got paid to do this. So you get paid to put your money on the table, basically. So I got paid $5, not that much, but I just kind of wanted to do this as a quick demonstration on how this works. So because AMD went up in price, the potential from these options to get assigned went down. That's why the value of the contracts went down. And now if I wanted to close this, I only have to spend $1 to do it. Now I am going to close it just because I like to, like I said, I like to do things on my own. So I'm actually going to try to close this spread right now. So let me go back. And in order to close this, because I got paid to open it, if I want to close it, I have to spend $1. So it's going to cost me $1. Hopefully we get filled. Wait, what? Oh, one contract, my fault. So I got one contract. I'm trying to sell it back for $1, and let's see what happens. Hopefully we get it, and then in essence we made $4. So we didn't make the full 5. If we wanted to make the full $5, I'd have to let this thing expire worthless at the end of the week. Now, in reality, that would be a good idea, just to make the full $5, but I'm not gonna trip over $1, and I kind of wanted to just get out. So then, if I want to get into another credit spread, I can. So let's just try to get out of this, and let's see what happens. So I'm probably gonna spend $2. So in reality, I'm only gonna make $3. Let's try doing this over. Continue. Like, this is really worth like $1, but I might have to spend $2. Let's try to do this. Alright, so we got filled. Let me go ahead and put that in here. So this was really just a demonstration. Obviously, there's ways to be able to make more money doing credit spreads, but I'm going to take that $3. You know, that's $3 that I didn't have last week. So now what I'm going to do is, because I got that $3 and it's locked in, I'm going to take that and put it into Apple. So I'm kind of using Apple as like my demonstration for long-term investing, which is what everybody should be doing. If you're going to be doing things like I'm doing, like selling options and doing credit spreads and all that, you got to have a long term, because the long term is what's going to help you become wealthy, create generational wealth, help you retire early, because you're going to have this savings account basically in the stock market, and we're just exponentially growing this. So when I bought Apple last time, it was like $116, but for some reason, you know what I'm saying, Apple surged today and it's at 119. So if I go back to my messages and look at Apple, let me show you guys real quick. I spent $8 to get into Apple, so I got fractional shares. At the time, it was $118 a share. Then Apple started dropping, so Apple went down, and I put $6 of money into Apple, and it was at $117.30. So it dropped a whole dollar. I put more money in. So a lot of people would think like, well, if it's dropping, you should take your money out because you're losing money. But let me show you how I ended up making money off of this. So remember, $118 is what I originally put in. And just for the sake of the argument, let's say I bought it in shares. So instead of saying I spent $8 worth of Apple, let's just say I bought one share. So I bought one share of Apple, then it dropped down $1. I bought another share of Apple. Then it dropped down again, not quite $1, but down to 116. I put $5 more in. Let's say at the end of the day I bought 3 shares. So let me see if I can write this down somewhere. Alright, so let's say I bought one share at what was it, 118? 118.30. Then I bought another share at 117.30. Then I bought another share at 116.58. So if I just held on to that one share, and let's say it's trading at 119.30 right now. I don't know what it is, but let's say it went up $1. I'm only going to be up $1 with one share. Okay. Because I bought another share down here, I'm going to be up this $1 from that first share, but I'm also going to be up $2 from this second share. So now I'm up a total of $3, right? Even though it went up to this price. Because I bought cheaper, so these ones made more, these ones made more money. And then, well, let's just say this is 16.30, so I'm going to retract this. So let's say I bought another share right here, and now this one's up $3. So I made $6 because I bought more shares as the price was dropping. So when stocks drop in price, that's like buying opportunities. So as the stocks go down, you want to get in. So if I was to go back to Apple and just look at the stock itself, let me go back to Apple. It says that I'm up 1.86% because I was averaging in. I was putting more money in as we go along. If I waited for Apple to come back up to my price in order to get in, I'm only making what I would get off of that first share, so $1. So if I waited, let's say I waited until it hit 118.30 again to buy my second share, I'm only going to be up $1. And if I did that again for this one, I'm only going to be up $1 as well. So as it goes down, you average in, and when the price comes back up, you actually make more money. So that's why it's important, and that's why I'm showing you guys as everything happens. Even when the price is dropping, when the price is rising, there's never a bad time to start investing. And when you see prices dropping, that's the best time to get in. And basically, when prices are dropping, that just means that people are selling. So somebody might have bought Apple at like $110, and now it's at 119. They want to collect their profits. So once enough people are doing that, the price is going to drop just because people are selling. So there's more sellers than buyers. So that's what causes the price to drop. And then as the price drops, people want to get in now because it's a little cheaper than it was before, and that's what makes the price go back up. So it's just supply and demand, basic economics. That's how that works. So I'm actually up right now a lot because of that. So I didn't get to put that $3 into Apple like I wanted to before the market closed, but I'm going to do that tomorrow. So I got $3 that I can use on anything I want to. I'm going to put it into Apple, and I'm just going to keep Apple as my my long term. So I'm going to keep putting into Apple until I get one share of Apple. So it's going to take like quite a long time, but I just want to show you guys that this is a marathon, not a sprint. And you got to be able to put money in as you go along. So if you're able to save $25 a paycheck, $25 a month, whatever you can, you just throw that in there, throw it into a stock, let it sit there, and as you go on, you add up, and you're going to see you're going to be up quite a lot of money really fast. And that's how it works. So stay tuned. If you guys have any questions, please leave a comment down below. I'll answer that in the next video, or I'll answer that in the comments. And stay tuned for more videos on stock market terminology, different stock market things. So stay tuned. Have a good Monday. I'll see you then. Peace.